Have you ever wondered how wealthy entrepreneurs lower their tax bill every single year? Well, you're in luck because today I'm going to share with you one crazy tax loophole that they take advantage of every single year called the Augusta rule. Hey, my name is Brian Nguyen and I'm a CPA and a tax advisor with CleverProfits, an online accounting firm for agencies, coaches, and creators. And if you're new here, please go ahead and hit the like, share, and subscribe buttons down below for more weekly tax and finance updates. So today I'm going to share with you the crazy tax loophole that is called the Augusta rule. And it starts with the small town of Augusta, Georgia, where they host a Masters tournament every single year. And what they do is residents will actually rent out their places for a week or more at a time to attendees and participants of the Masters tournament and collect a pretty handsome sum of rental income along the way. Now the problem with that is that they have to include the rental income in their tax return, which is a no-go because now they're going to have to pay taxes on it. So at some point in time, Congress decided, you know what, we're going to give these people a break and we're going to let them exclude that income as long as it's less than 15 days in a year that they're renting their home that they live in to these individuals. So in short, as long as you rent your home that you live in for less than 15 days in a year, you don't have to include the rental income. You lose out on the tax deductions, but hey, that's okay because at least you don't have to include the income and all as well. So how does this actually apply to you if you're a business owner who's trying to take and expand your tax deductions? Well, there's nothing in the rule that says you can't rent it to a business and have the business take a tax deduction for it as long as it's a legitimate trade or business purpose under 162, ordinary, necessary, and reasonable. So the key here is, well, why don't you just rent your primary residence to your business for a legitimate business purpose, and your business can take a tax deduction for it for up to 14 days in a year, and you don't have to include the rental income on your personal tax return. Boom, massive loophole right there. And so a lot of business owners have kind of gotten creative with how they apply this. And keep in mind, this has to be legitimate, otherwise you can't take a deduction for it. So it has to be a true business purpose. And I'm going to go over a few different use cases that we use with our clients right now. The first one is if you're on YouTube, or you're doing any kind of video advertising, or you're doing any kind of online coaching that requires a full use of your space and a camera, like a production. And there's nothing that says that you can't have your business rent out your space for a day in order to do any kind of video related production. In fact, I'm doing a video right now and I'm probably going to use the Augusta rule and take advantage of that because I'm going to use the entire space in order to actually film this video and get it online for my business. So that's an example of a business use case where you can have your business pay you for your space and your business can take a deduction for it, and as long as it's less than 14 days in a year, then you can exclude the income. Another use case is if you host events at your home, kind of like a mastermind, where you use your entire space, you invite attendees over, and they use your space in order to actually facilitate your mastermind. And this is really common for a lot of our clients who operate in the online coaching space. And it's huge and it can save you a lot of money because you don't have to go out to another vendor off-site and pay them for it. Why not just pay yourself out of your business funds instead, and then your business can take a deduction for it and you don't have to include the income and all as well, as long as it's less than 15 days in a year. So those are two really cool use cases. The last case is a little bit less common for our clients because most of our clients own their business outright. But if you have a couple other shareholders in your business and you're having a shareholder meeting and you invite them over, like if your spouse is a shareholder, for example, then you can use your home and your space to host your board meetings or whatever, and you can have your business pay you for it and take a deduction. So those are all really cool examples of how you can have your business with a legitimate business purpose pay you for your space, and your business can claim a benefit, and as long as it's less than 15 days in a year, I'm going to continue stressing this, you're going to get a tax deduction and you can exclude the income on your personal tax return. So what do you actually need in order to facilitate taking this tax benefit and not having to include it in your income under the Augusta rule? Well, it goes back to making sure that you actually have a legitimate business purpose in order to actually claim the deduction at the business level. But what a lot of people forget is that you need to actually have a transaction between one party to another, i.e. your business to yourself. So you actually need to have a business that is operating as its own tax entity, which requires either an S corporation, a partnership, or a C corporation. You cannot do this with a disregarded entity, so single member LLCs that haven't elected out of their default classification will not have this apply to them because you can't have a transaction with yourself, which is what a disregarded entity kind of is. So it's got to be a separate regarded entity, which means that S corporation owners have an advantage here because they can take advantage of the S corporation rules and also look at the Augusta rule and apply that on top. So if you're looking into an S corporation election, that's definitely a more favorable argument for having one. The second thing that you need is to make sure that the price is reasonable. You can't just rent it out for an extraordinary amount that's not consistent with local rental prices in your area for your space for the day. How do you know what a fair rental price is? That's a great question. We get that all the time. Well, one way to look is to look on Airbnb and see what an equivalent unit for your space would cost for the day, or go to VBRO or any other kind of third-party provider where you can look and check rental prices in the area and have some documentation and support so when you're claiming this deduction, it's not bogus, and you can provide that information to the Internal Revenue Service if you were ever to get audited. The last thing that we want to make sure of is that you're actually transacting with your business when you do this, which means that you need to have an official invoice that shows and documents the day, the description of what's happening, and how much you're charging your business for the full benefit of their rental, and to make sure that your business actually pays you for it in order for the transaction to be legitimate. Remember, businesses can't claim a deduction unless there's a cash basis outflow, which means that they need to actually pay your invoice in order for the deduction to show up in their books and ultimately be claimed on the S corporation tax return. So it can't just be something fictitious that you do at the end of the year after the fact. You got to make sure that you're adequately keeping records of this, invoicing your business properly, and making sure that your business is claiming the full extent of the benefit along the way by actually paying you for it. And the last thing you need is to make sure that you file a 1099 MISC for the rental income at the business level, making sure that the IRS is aware that you have some rental income and that you're meeting that requirement, and that you're excluding that income on your Schedule E, because again, it's excludable income and your business will take a deduction for it on whatever tax form it files. So if it's an S corporation, it's going to be the 1120S. If it's a partnership, it's going to be 1065, and if it's a C corporation, it's an 1120. So those are the different options, and in order to take the benefit, you have to make sure that you meet every single one of those requirements, and ultimately this can easily be $1,000 or $2,000 back in your pocket at the end of the year, or more, depending on how much you actually rent your space to your business for its full value. So if you have any questions on the Augusta rule, please hit us up, drop a note in the comments down below. And if you want to learn more about these awesome tax strategies that you can use in your online business, then you're going to want to watch the next video and go ahead and hit that subscribe button so you can get our weekly updates on all things tax and finance related. Thanks for watching. If you liked what you hear and you want to take advantage of more tax strategies, we have so many more videos on the channel that are going to be coming out explaining how we help our clients save tons of money. And you can check out the videos by hitting that like, share, subscribe button and go into the next one right here.